Recording? Episode 12 coming in hot.
Episode 12. Does anybody need a refi out there?
I do. I need a refi. All right, you want to go for it?
Sure. All right. Hello, everyone, and welcome to another episode of the Lending Podcast. We are your hosts. That's Jeff Jones.
Hello.
And I'm John Burnham. Thanks for being with us again today. And we've got a great topic for you. We're going to talk about refinancing. We get a ton of questions. Where are we going to start with this one? Because we could go a lot of different directions.
I think this is a great topic right now because, being March of 2024, we really kind of have higher rate market than most people remember in the last decade. So I think it's a perfect time because it's like, when is a good time? And what are the different kind of options available?
Absolutely.
And I think that just understanding the numbers, understanding how the break even comes into play, your monthly payment comes into play, closing costs come into play. I think this is a very good time to talk about refinance.
Yeah, I mean, everyone has so many different goals out there when you're looking at refinancing. And to be perfectly honest, you touched on break-even analysis. The most common question we get is, how much do the rates need to drop in order for it to make sense? And the truth of the matter is, it's not really how much the rates need to drop. It's what the costs are associated with the refinance and then what the savings is going to be.
That's right.
And so if your savings is substantial and your costs are minimal, then there's really little reason to wait, let's say, on refinancing. But there's a lot of cases where it might cost $4,000 or $5,000 to do a refinance, and it's saving you $50 a month. That's not worth it. It's going to take 100 months to break even. So we really break down how much it's going to cost and then how much your savings are going to be. And it's different for every single scenario. Not all refinances have costs associated. There are no cost refinances out there. So how does that work?
I think the amazing part with, a rate term kind of refinance, there's two different types. With the rate term, you're basically rolling all your mortgage into it and all your closing costs into it. So you're not paying a dollar at closing.
That's right. Yeah, so the rate and term refinance will allow you to either bring your closing costs to closing, you can pay them in cash, or you can roll it into your loan balance.
Right.
Or in certain circumstances, depending on the loan type, there are ways for the lender to cover significant amount of those closing costs. And that's really what we are anticipating in the market as lenders. As rates go down, they are projected to go down over the next 6, 12, 18 months and beyond. There will be less cost associated with each mortgage. And that's been one of the challenges we know in the marketplace over the last couple of years is not only have the rates gone up, but the costs have escalated as well. And that's made it increasingly more challenging for some of our clients to do a refinance, because in the past there were more options available to minimize those costs.
And I think that's the timing, and a good refi is like a good joke. It's all about timing. But
well said.
But there is another side to that on the inverse to balance that kind of concept out. When people ask us, when is it right to refi? Sometimes that isn't about timing. It's just about the numbers.
That's right.
Right. And so it's not what's going on in, the federal government, if they're going to be doing rate cuts. It's not about, is this going to be a buying season or selling season? It's actually just about the analysis of when your break even is and how long you're going to be in the home.
Yeah. So let's run through a quick break even analysis using some super simple numbers. Okay. So we're going to take a $400,000 mortgage. Okay. And let's presume that the client can reduce their interest rate by 1%. Okay. So whatever their interest rate is now, let's say they're at 7.5, they're going to go to 6.5. We're just going to pick some numbers here. So you have a $400,000 loan and you're going to reduce your interest rate by 1%. You're going to save about $4,000 a year in interest. Okay. Call it $300 to $350 a month. So if your closing costs are $4,000 to $5,000, let's say, that's about a 1-year break even, right? So in many cases, my personal philosophy, doing this for a long time, my philosophy is I really want to see a break even for sure less than 24 months. Right. It also depends on how long you're going to be in the home, right? So we ask those kinds of questions. If this is your forever home and you're never going anywhere and you're going to be in the house forever, then you might be able to stomach a slightly longer break even analysis. Maybe a little bit more cost, little less savings per month, but over time you're going to save a ton of money. And so we're going to run all
Right.
those calculations. And I just think that the most in its most simple form, if you can break even in 12 to 18 months, it's a no-brainer.
And there's something about like if you are going to be in the home for a lot longer than 2 or 3 years, then even just that lower monthly payment is a budget help every month, even if the cost is a little bit higher and you're going to break even while you're still there anyway. But the monthly budget is a big deal.
That's true. And with property taxes presuming to go up over time, home insurance most likely will continue to go up over
Right,
time. Your principal and interest, your mortgage is set. So
right,
when those other costs start to increase, refinancing is a great way to offset that and not necessarily extend the term of your loan too. So let's dive into that real quick because I think this is an objection that we get sometimes. If you're a few years into a 30-year fixed, and then you do a new 30-year fixed, that can make your loan 32 or 33 years, right? Well, that's not necessarily a mandatory thing. You can do a 25-year loan, let's say, on the refinance. So you're in the mortgage 2 or 3 years, you got 27 years left. Put yourself on a 25-year fixed. You're cutting 2 years off the loan, and you still potentially
right.
would be saving money on a monthly basis. So then you take out those 24 months of payments that you're saving at the end, presuming you're in the house for 25 more years, which we understand may not be very common, but it
Right.
happens, right? And so if you take that savings, the amount of principal that you're paying down, when you go to sell the home, you have that much more equity.
And some people are, what I've noticed in a trend is people are a lot of times keeping their current home when they buy their next home and turning it into a rental. And that's a great another way to keep that cost, closer to what it was and what was expected when those other costs rise.
Absolutely.
So,
Yeah, because you want to look at the market rent. You
hmm
want to look at what is your new payment going to be on your future home, and then what kind of cash flow could you get if you are keeping your house and
yeah,
renting it. Maybe there's some positive there
yeah.
that helps offset that purchase that you're looking to do. So yeah, there's a lot of different scenarios when it comes to refinancing, and I think the most common one we see, of course, is lowering your payment. Yes, but let's take into consideration some other reasons that someone might look at
Cash
refinancing.
out.
Cashing out, absolutely. So
Yeah.
let's unpack that because right now we've had a lot of hesitation for buyers in the marketplace and because of interest rates, right?
hmm
And we all have this anticipation in the next 6 to 12 months that rates will come down. And it's really been explicitly said by the Fed. They're going to be lowering the short term rates that should affect
Right.
mortgage rates. They're not correlated, as we know, directly, but it could affect that. So if we anticipate that rates are going to be coming down, then refinancing right now might be a hesitation for some folks because they
Sure.
say, well, I'll just wait a little longer to refinance. And in some cases, that is the right decision. I don't think it's the right decision necessarily for the purchase delay, right?
Right.
Because you get into the home now, we say date the rate, marry the house, right? So you get into the house now, and then when rates come down, you're refinancing into a lower rate. So if we're refinancing today, how much longer does someone have to wait? Can they refinance again in 6 or 12 months or
Yes.
18 months? Yeah.
Yes.
And there's certain types
Yes.
of loans that you may have to wait.
Right.
If it's a cash out loan in Texas, you have to wait 12 months and a day before
hmm
you can refinance again. Those are Texas home equity laws if it's a home equity. If it's a rate and term refinance, which we're going to talk about that,
Yeah.
rate and term refinance versus a cash out. So, what is the fundamental difference of those two? And they kind of are implied in the name,
Yeah.
but
And that's if you are wanting like a lump sum of cash and you're doing a cash out, a rate and term, you're getting no money back to you. That's the
that's right.
simple version,
Yeah. And you
right?
can, on those rate and term refinances, which a lot of our clients don't realize, you can roll in your closing costs. Like you
Yes.
said, you can roll in maybe some new property taxes to set up that new escrow account. You can roll in your home insurance. If any of those are overdue, if they are past due taxes, past due insurance, you
hmm
cannot roll that in. That's considered cash out. But if they're current taxes, current insurance, closing costs, you can roll that in and therefore bring very little to closing in
hmm
most cases, depending on the loan type. And so I think the advantages and disadvantages of the different types and styles of refinances depends ultimately on our client's goals.
That's right.
You know, we are really listening, we're really understanding what you're trying to accomplish, and there's just so many other things. So let's dive into another aspect, which would be refinancing somebody off of a mortgage. So two people got a loan together,
Yeah.
okay? Now, they may be married or unmarried. And we say in the credit world, we say people separate, credit does not,
That's
okay?
right.
So when two people decide, okay, we don't want to have this house anymore, but one person's going to keep the house and then the other person's going to go do something else.
Right.
That person that's going to go do something else, just because they're maybe removed from the ownership of the house, does not mean they're coming off of the mortgage.
Right.
So in order to get them off the mortgage, there's really only one way to do it, and that's refinancing.
Yeah.
And sometimes that might be going from a lower interest rate to a higher interest rate. We understand that. That's unfortunate. But again, it could be temporary. If and when rates come back down, then that person that still owns the home can refinance again by themselves. And they have to qualify by themselves. And that's the other tricky part is sometimes if two individuals are buying a home together, they're qualifying together, and
Both
maybe they
incomes,
needed both
both
of them,
assets. Right.
yeah, to get the loan. And now we're trying to do a refinance and remove somebody. That it can be tricky. So you need you need a mortgage professional to navigate that with you, because it isn't always as simple as just, well, we're just going to take this person off and redo the loan, right?
Yeah.
There's a lot of moving parts,
Mm-hmm.
you know. Now another thing that we could talk about, and there's so many variables, right, when it comes to refinancing, that the other big one is the appraisal. Okay, so let's talk about
Right.
the appraisal value and what the specifics are when you are going through a refinance. There are programs that do not require appraisals, believe it or not. Government loans do not always require an appraisal. So FHA or VA, we call those streamline refinances. But conventional loans, most of the time, are going to require an appraisal. So if a client's getting an appraisal and their value has grown, does that help their loan terms, or does it matter really?
It greatly helps the loan terms. So the loan to value, the LTV, is really what we look at too for part of the not only the pricing paradigm, but really just the value that you can pull out. So if you're doing a cash out, say you're like what they call phrase house rich and cash poor, and you need to pay down some debts and it's a hard time for you, it might be a good time to cash out because the value of your home continue to build equity year over year. And to see what that could be like, get a hold of a mortgage professional. We put together our best estimate, but really it's going to come down to what the appraisal values it at. And that's what we have to hold to.
That's right. And the appraisal value, of course, is taking into consideration the most recent sales in the area.
Right.
Usually they go back 3 to 6 months, sometimes a year, try to stay within a mile to 2 miles potentially of the home. And so if you've had a lot of activity around your home recently,
Mm-hmm.
you may see that appraiser has a lot more data to analyze your home and to determine a value. If you're in an area where there's not a lot of value, this is just like a purchase as well, very similar.
Right.
If there's an area where there's not a lot of value, sometimes it's harder for those appraisers to determine a value because there's just not as much data, and there's not a purchase contract. They don't really know what the buyer's willing to buy it for, the seller's willing to sell it for. This is a refinance transaction, so we do see refinance appraisals sometimes coming in a little more all over the map.
For sure.
And so that's something we want to pay really close attention to.
Right.
As your lending advisors, we're always going to present to you worst case scenario. So we think the home is worth X. We're going to base all of our refinance numbers based on that X value. And then, hey, if it comes in higher, that's awesome. We may see better terms. And the more equity you have, the lower your rate could be potentially. Depends on the loan type and a lot of other factors. But that's something we're really looking for. And full transparency, we're going to disclose that. We're going off the worst case scenario, but
Right.
hey, if your house comes in higher, your rate could be another quarter lower or a half point lower. It just depends. And so that's going to only add to the savings once we've decided that worst case scenario makes sense.
And I think that's good that you talk about, once the appraisal comes in, because a lot of times we do a lot of prep work on the file ahead of the appraisal just to get things going for you, get rates locked in, get kind of your estimates of, your your cash that you can draw on the home. But once that number really comes in from the appraisal, that's when things get dialed in. Kind of like we were talking about on our last episode about like we create, you know, a drawing of what we're hoping for. But once we get the actual final number from the appraiser, we can work that backwards
That's
into
right.
the terms. But another thing that comes into mind is there's a lot of opinions of what houses are worth out there before an appraiser gets there. And so your county appraisal district, what you're getting taxed on the value of your home, that is nothing like there's no similarity to that number of the county appraised number compared to what your actual appraised value is.
So it does not correlate.
Same with online estimates from housing websites.
Popular websites that we won't mention, but
Yes.
yes. So you really have
Yeah.
to, and that's something we order. The borrower, the homeowner does not order the appraisal. We order that through a third party.
Right.
All of our appraisers have been through extensive training. They've been approved to do appraisal work because of their background and because
Right.
of their reputable professionalism and the quality of their work. And so they're going to contact the homeowner. They're going to set up a meeting. They're going to go to the house. They're going to measure most of the time, measure the home and take interior, exterior photos so that they can really give you as a homeowner every bit of value that you have put into the home. You've updated the kitchen, you've updated the floors. That doesn't really come across in an exterior only or a drive-by appraisal. So although those are nice, we just need a drive-by appraisal. That's great in theory, but it may diminish some of the positives of the inside of the home or the backyard or some of the work that you've done. So we really want to do a full appraisal if needed. Again, sometimes we may not need it. That's great. It can save a few dollars. But I think the professional third party appraisal is something that really can benefit our clients, help you get the best refinance terms. So we really put a lot of emphasis on that.
Question for you. So if I'm a homeowner, I'm sitting on my home, I've owned it for a handful of years, and I know that I'm happy with my neighborhood. I'm going to be there for at least another 3 to 5 years, but I really want a pool.
Yes.
Can I refinance and have that pay for my pool?
Sure, potentially. Yeah, so there's a program, really cool program called Home Style Renovation. And I'm speaking on a conventional loan here. There are maybe some other options. There's home improvement loans, there's home equity loans we've touched on before. But let's just talk about this home style renovation product for a second because it takes your existing balance, loan balance, and then it adds the amount of the pool into that, and it becomes one new mortgage, right? And because it's not an equity loan, it's not considered a home equity loan in Texas, we're refinancing your pool into your mortgage. Those proceeds that you're getting from your home are going to pay that contractor. They're going to pay the pool company. They're not going to the homeowner. So therefore, it's not a cash out type of mortgage. So you can roll those two together, get an appraisal that at least supports a value that has 5% equity still. So you have to at least have a 95% loan to value after the pool is in. The appraisal is going to include the proposed pool, right? So we're going to appraise your home as if the pool is completed, and there still needs to be a little bit of equity. And so about 5%. And so that's a really great product. Again, it may or may not be the right structure for a client who has a really low interest rate on your home right now. We don't want to pay that super low interest rate loan off and include the pool in some cases, but other cases it might make sense. If you don't have a lot left over on your mortgage balance right now, and let's say it's a really nice pool, it's a $200,000 pool or whatever, we look at that blended average, that weighted average of the interest rates, the blended rate, and we can make a case for potentially doing that type of loan.
Yeah.
So there's just a million different scenarios out there, and pool loan companies also have their own financing, and sometimes that's the best way to go too. Like we'll tell you, hey, what are they offering you? Here's what your options are with a mortgage company. And in some cases, that may be the right way to go as well. So it's just evaluating those options. Yeah. So the other thing that we didn't really touch on, and I want to go deeper on closing costs.
Good.
Okay.
Good,
so
good expectations. Right?
Yeah, that is probably the most, other than what's your interest rate, is what are the costs, right? What are the closing costs for a refinance? And without being cryptic, It depends. It depends because the different loan programs have different closing costs, different interest rates come with different closing costs. And so, what are some of the standard costs? Well, you're going to have title policy, right? You're going
Hmm.
to have some title fees. You may or may not have that appraisal. The mortgage company may or may not have an administrative or underwriting or processing fee, right? So there's some basic costs. Then above and beyond that, there's that other bucket.
Of
You kind of
prepaids.
compartmentalize the
Yep,
costs, and those prepaid items, your taxes, your insurance, that can be a really big chunk
it can.
of your settlement charges, which is money that you're going to pay anyway, right? It's money that you would pay if you didn't even have a mortgage, right? You're going to pay property taxes, you're going to pay home insurance. And so I think a lot of times closing costs, everything gets lumped together, and it looks like a big number because it's like, oh my gosh, the mortgage company
Right,
is charging all these fees. Very few of the costs are actually related to the mortgage itself.
right.
It's the third parties that were organizing and orchestrating, right, to all come together. So
And coming back to timing,
yeah,
so the prepaids, specifically your big ticket items of property tax, that can be one of the biggest costs rolled into that loan just because they are rebuilding a new escrow account,
hmm,
right? So your old current escrow account gets settled, right? And there
yes,
might be a chance too some of that comes back to you.
right.
But that all depends on timing. So depending on what month we're in of the year will depend on how much escrow really needs to get rebuilt and started over for you.
That's right. Oh, that's a good point,
Yeah,
and it's very confusing for a client because
it is.
taxes are always due for the most part in December,
Right.
but insurance could be due any of the 12 months of the year. It really is on your
Renewal.
anniversary date,
Yep.
of when you bought the house, on your renewal date. So we're looking at building that escrow account, that new escrow account, so that when those two bills are due, the escrow account has enough money in there to then pay those respective bills.
Right.
So the earlier in the year you're closing on a refinance, the less amount of taxes we're going to collect. But the insurance, of course, is going to depend on when your anniversary date is. But the later in the year we close, say August, September, we're going to be collecting almost a year's worth of taxes up front because we need to put it in the escrow account to be ready for the taxing authority to send the mortgage company that bill. The mortgage company gets the bill, writes the check, or sends the wire, however they pay it, to the county. And so that escrow account has to be full enough to get those taxes paid. Otherwise, you'll have a shortage. And so we get a lot of questions about shortages
Right.
versus surpluses and in your escrow account. And this episode's not necessarily all about escrow accounts, but it's a big piece
It's
of
one of the
what we
biggest
do.
costs on your but since it's a prepaid, it's almost like you have, let's just use the analogy of cups of water, right?
Mm-hmm.
So if your current mortgage is escrow in your taxes and insurance, it's every monthly payment you have is pouring a little bit more water into that cup until it's full in December and pays off your balances. But say you're closing in November, which is one of the biggest months of getting a prepaid set because it's
Right.
right before they're due, you know, that cup has been almost full and now you're refinancing. So that means this new company has to have a cup that's almost full,
Right.
right? So what's nice that people don't realize is even though we're collecting all these new prepaids and rebuilding that balance to 11 or 12 months of prepaids, this other one gets poured back to you after we close.
That's right.
So
Yeah.
it does make you whole.
Yeah, and there are times where escrow accounts can transfer in the
Right.
industry. They could go from the existing lender to the new lender. It's possible. It doesn't happen super often, but I like that analogy because it really is you're building that escrow account throughout the year,
Hmm.
and then in December, let's say you're refinancing in the month of December. A lot of times the property tax check has already been cut,
That's right.
but the county may not have received it yet.
Or recorded it. Yep.
Exactly. So we're monitoring that as well, and
Hmm.
really just letting you know, hey, what are some of the pitfalls that may show up, or sort of
Right.
curveballs that may hit us, and we're preparing you for that as you're going through this refinance process. So yeah, so there's a lot of pieces of the puzzle. I think ultimately, just when you're considering refinancing, understand like what your goals are, what your financial goals are,
Right.
And for a lot of our clients, many of our clients, it's to lower that monthly payment, right? So we are looking at what are the strategies to do that, and we'll present two, three, four options to
Yep.
you.
And we'll go over a
A
break
handful.
even,
Yep,
and we'll just make sure your monthly budget's great for where you want it. And it could be a good time for people out there. I know people aren't thinking a lot about refinance right now, but if you are curious about it, or if you're curious about upgrading your home with major upgrades, we'd love to talk to you.
absolutely, yes. And again, keep that as a strategy out there as a buyer, as a potential buyer, when you're looking at properties and you're thinking to yourself, "Gosh, the rates seem a little high right now."
Right.
Have that refinance talk up front with your lender. Find out, what will my refinance strategies look like. And
Right.
it's going to depend how much you're putting down, and how much, what your loan type is, and how long you may have to wait until you refinance. Some programs you have to wait 6 months because they want to make sure you've made those appropriate amount of payments, or you got to wait 6 months until we can use that appraisal value. If you're buying a property that's undervalued and you want to refinance using the equity in the market, you may have to wait a little bit of time. So just have those conversations. We're happy to do that, and appreciate you being with us today.
Yeah, this was a good one.
All
Thank
right.
you so much for tuning in to the Lending Podcasts. JB and I are happy that you're with us. Please like, subscribe, and share. And thank you so much.
Take care. We'll talk to you soon.